Welcome back to Breakfast. After months of political wrangling, the controversial sale of state-owned assets is all but a done deal, with the mixed ownership model bill looking ever more likely to pass if only by one vote. The government has maintained that at least 49% of the shares will stay in New Zealand-owned hands. So what does that mean for everyday investors keen to buy shares? Craig Stobo is an investment advisor and he's with us now. Good morning.
Good morning. How are you, Petra?
Well, thank you. If we could take this out of the realm of politics and look at the investment opportunity, is this a reason for people who might never have bought shares before or who are small-time share buyers to get excited?
Sure. Just a qualification first, Petra. I'm not a qualified financial advisor, so people need to think about this as comments in principle and obviously need to talk to their own advisor about these sorts of issues. But is this a good thing? Well, I think all of this sort of turns out to be a question of what the price is that these assets will be sold at, and of course we don't know what the price is yet, and that's a key piece of information that investors need to have.
There's been a lot of talk, because obviously it has been in a political realm, about how do we keep the shares in New Zealanders' hands. There's been a loyalty scheme mooted where if you hold on to your shares for a period of time then you get extra free shares. Is this a scam, as the opposition are saying, or is this a good idea?
Well, it's not necessarily a scam if it's completely transparent, but I think you're kind of fighting a losing battle. We work in global markets, and inevitably, if these assets are attractive, then foreign buyers will want to own a slice, and I don't see why investors, mums and dads, who own shares shouldn't have the right to sell to the highest bidder on the day. And if that happens to be a foreign buyer and they want to sell, then why should they be stopped?
So is a loyalty scheme worth anything then? Because my point was, thinking-wise, if you are getting into the share market as an investment, then you want to make money, and to realise that money you do, as you say, have to sell the shares.
Well, you might want to be a long-term holder because of the nature of the asset that you're buying. It has certain income stream characteristics, it has certain risk characteristics that you like, and it suits your portfolio. But sometimes you are forced to sell because of personal circumstances. And if you need to sell, you probably want the highest price on the day. And if the market's constrained by some sort of ceiling, that doesn't seem to me to be a very good investment. It's certainly a constrained one.
What about this idea that Bill English has offered the opposition the opportunity to say, look, if you're so against this deal, then you can say you'll buy back all the shares. If the opposition came out and said something like that, which is we would force a buyback, how would that affect the market and the potential investors?
Well, that's one of these risks that you have to weigh up with these asset sales, and we've seen in other countries people nationalise, or governments nationalise industries. So you've just got to be careful about the politics of a major shareholder being a 51% shareholder, being the government, who is both a referee in terms of regulatory management and also a player in terms of being a major shareholder in these businesses. So I think you just got to be very careful about what you are going into with a major shareholder being also the regulator.
Do you think that puts the shares in a better or a worse position in terms of investment?
Well, I think it probably comes down to how directors on those boards manage key issues like, for example, hiking the price of electricity. Does the referee, who's also the owner, say no, and the private investors who have their directors on the board say yes? How does that play out? And I think that's a very interesting question for boards to have to manage. So it's not all a game of skittles. It's quite a lot of risks around how these assets will be managed.
Is this new territory? Have we seen this done in other countries and can learn from them?
Oh, absolutely, and I think that's one of the interesting things, is that we obviously live in a global universe of opportunities for investors, and New Zealand mum and dad investors, whether through Kiwi or directly, should be asking themselves, in the global set of opportunities, are these the best, for example, power companies that I could have in my portfolio? Maybe I'm better off owning power companies elsewhere. And that's the flip side of the foreign investor coming into our marketplace. Mum and dad investors have got choices too. So these assets better be priced really well for a successful float. However, a low price which might benefit investors is, of course, an expensive outcome for taxpayers. So at the very beginning of this process, we have tension between the taxpayer, who would like a very high price for these assets, and investors who would like a low price. And how this plays out in the scoping studies and the final price will be very interesting to watch.
All right, Craig Stobo, we will watch it indeed. Thanks for joining us.